Hi, my name is Caroline McCaffery. I am the CEO and co-founder of a company called ClearOps, and I'm excited to be here today to talk to you about going from the idea for your startup all the way to fundraising. It's a 1-hour crash course. We're going to go wide, not deep. Hopefully we get through all the content today. But before we start, I'd like to introduce myself more formally so that you have context for why I'm talking about this. I began my career a while ago. I'm actually an attorney by background. I have been working with startups my entire career. I started out by working for a law firm that exclusively represents technical and biotech startups, as well as the VCs that invest in them. My practice specifically focused on representing the startups themselves. So I did quite a lot of deals. I was a corporate securities attorney, so I did quite a lot of financings, including both debt and equity, a lot of incorporations and formations. As outside counsel to startups, you also tend to do quite a lot of other things that are just based on the demand and the requests of the startups. And I also did some work on the VC side. And then finally, I also did a lot of mergers and acquisitions. And so that was basically the first 10 years of my career. After that, I wanted to go in-house. So I joined a startup as their first general counsel. That startup has since been acquired. But the startup that I joined was a marketing automation company called SailThrough. They've been acquired by Campaign Monitor. And at SailThrough, I became very, very interested in privacy. And so while I was there, I got my privacy certification with the International Association of Privacy Professionals. A privacy certification means that I had to understand all the various privacy laws, particularly in the United States. That was my focus. And then in 2015, I moved to my second in-house position with a company called Clarify. At Clarify, my role expanded beyond just being the general counsel. I also became the VP of operations, where I was responsible for the people department, finance, operations, security, and then, of course, legal and privacy. So after that experience at Clarify, where my role expanded quite a lot, and due to my interest in privacy and seeing what was happening in the world with respect to the right to privacy, the laws that were being drafted or even adopted, I had an idea, and I had a person that I had met. We actually met in 2015. And his name is George, and he's my co-founder, and he is a security expert. And when I met him, I thought to myself, there's a possibility here for a company. Didn't envision going to start my own company back when I started out graduating from law school. It was not on the agenda in terms of my career. However, we had an idea, and we wanted to see if it would work. And so that's why I'm talking to you today from idea to fundraising. As an attorney for startups, the interesting thing for me is I was very, very accustomed to receiving the term sheet from the startup and having to start from that point. As a founder, everything before that was new to me. So having an idea, executing on the idea, and turning it into an actual company is not something that I had experience with. But I did have experience with working with companies who did do that. So I thought maybe it would be fun today to go through all the different parts of what happens when you just have a basic idea to getting fundraised. Now, ClearOps is my current company. As I said, I'm the CEO and I'm the co-founder of ClearOps. And we went from idea back in late 2017 to where we are now. We have raised a friends and family round, but I am going to talk about more than just raising a friends and family round. I just wanted to give that as perspective as to what I have currently done so far. So let's get started. The first thing I wanted to do was set the stage for what we're going to talk about today. We're going to talk about forming your company once you have the idea. We're going to talk about co-founders. It's a question I actually get quite a lot. We're going to briefly talk about capitalization tables, advisors, whether you should join an incubator or an accelerator, creating your list of VC contacts, the go-to-market strategy that you will definitely need to figure out, designing and writing pitch decks. I have to add in privacy and security since that is what ClearOps is all about. And if we have time, I'll touch on a couple of other topics as well. This presentation, hopefully I'll get to everything. I have not been able to successfully complete all these topics in an hour yet. So I might go too fast. And if I do, I will circle back around and talk about things that I had to skip over, just in terms of trying to anticipate how much time we have. Okay, so congratulations, you have an idea. This is very exciting when you have an idea. One of the first questions and concerns that the founders I talk to have is, someone's going to steal my awesome idea. I completely sympathize with that statement. I myself was worried that someone was going to steal my idea, even though it was a problem that I personally experienced for years and no one had solved it for me. I couldn't find software that would help me with this particular problem that we're solving at ClearOps. I still thought someone's going to steal this idea. Even today, even though we have a product in market and we give demos all the time, I still sometimes have this reflex of someone's going to steal my idea. And even though that is a very, very valid emotion to have, I now know, and I want to share with everyone here, that it's all in the execution. There's no question that there's lots of brilliant ideas out there, but there's a lot fewer people who can actually execute on it. And so you may be in the situation where you're talking about your idea with other people, and you may think to yourself, should I have a confidentiality agreement in place first? And the answer to that question is maybe, probably not, because the person you're talking to isn't going to execute on your idea. The other part about having an idea is, should you quit your job and work on it full time? When do you need to quit your job and work on it full time? In my experience, what I did is I waited to quit my job for a couple of things. One, enough financial stability so that I could get to my first target for validation, for proving that I had an idea that was something that we could execute. The other reason why I left my job in order to pursue ClearOps full time was because in talking to a lot of different incubators and accelerators and VCs, they want full-time commitment. They want to see that you're so convinced of your idea that it's going to work, that you take that leap of faith. And then finally, how do you validate an idea? I highly recommend that you validate your idea before you go full-time on it. What does that mean, validating your idea? I mean market research. Just basic market research. Talk to 100 people, 1,000 people. Whether that's sending out surveys through LinkedIn or some other method that you have, finding a network where you can discuss your idea and see if your solution is actually something that people want. It's really, really important to validate that idea. Circling back to the confidentiality agreements, let's talk about the next phase of after having the idea. Forming the company. So having a confidentiality agreement between you as an individual and another person as an individual is okay when you're at the idea stage. But if you really are worried that someone's going to steal your idea, it's better to have formed the company. And as an attorney, one of the questions I get all the time is, should I form an LLC or should I form a C Corp? Without getting into too much detail as to the difference between the two, and I probably should have said this at the beginning, but disclaimer, I'm not giving legal advice at all at any point in this presentation. If you need legal advice, please consult with an attorney. I'm just giving you my experience as a founder. So why an LLC over a C Corp? Some of you may also be thinking, well, what about an S Corp? Or what about a B Corp or a benefit corporation? There's a few different types of corporations, but generally speaking, the C Corp is the entity that you're forming, and then something like an S Corp is a tax election filing that you're making. So it's still a C Corp. It's just your tax status is an election that you're making to change. So LLC versus C Corp, why the difference? The difference is it's for taxes. An LLC is a pass-through versus a C Corp, which is subject to double taxation. But there's a few things you need to think about as to which one to form. The first is your idea VC backable? If a VC is going to invest in your idea, or you want a VC to invest in your idea, that's the path that you're choosing, you're going to need to be a C Corp at some point. If you do not believe that you're going to go seek VC money, an LLC is fine. There is actually another reason why a C Corp is more beneficial than an LLC in certain cases, and it has to do with your small business status. I'm not going to get into that because it's very tax driven, but it's worth talking to your accountant. Anyway, if you do form it as an LLC because you prefer that tax pass-through benefit, if you're in Delaware, if you're formed in Delaware, which the majority of companies are, it's quite easy to then convert into a C Corp. However, I'm just going to mention it again, even though I said to go talk to your accountant. Starting out as a C Corp does have an eventual benefit if you are able to maintain your small business stock status. I would just want to briefly touch on the concept of B Corp versus benefit corporation, as these are becoming more prevalent and popular. If you're a benefit corporation, just be aware that there are quite a lot of reporting obligations. And that's all I'll say about that. Do I need a co-founder? So this is one of the ones that I find very funny, that people ask me this all the time. They hear that I have a co-founder and they say, do you think I need a co-founder? And how did you find a co-founder, Caroline? And I often say to them, like, it wasn't going to networking events and thinking to myself, I'm going to find my co-founder today. And so in my situation, I was always networking. I wasn't thinking about starting a company. I was just simply networking. And there was a person at one of the companies I worked for who left. And I said, you know, I really enjoyed working with you. Can we get coffee? He said, sure. And when we were having coffee, he said, I need to introduce you to one of my best friends. And I met his friend, who's now my co-founder, and he and I just had a fantastic conversation about privacy and security. And I know that probably sounds boring, but it's true. We couldn't stop talking about online privacy. It took another couple years before we actually had the idea and decided to start a company together. So when it's how to find one, I mean, my story is not a good example. I mean, you can't really replicate that in some forced way. So I like to tell people when they ask me this question, I'm like, I can't tell you how to find a co-founder, but I can tell you a couple of things. One, I am so glad that I have a co-founder. I'm glad that I have a co-founder because when times get tough, and they do, they have, he's the person who I know who's in it as much as I am. We have each other's back. The other thing about having a co-founder that I'm really glad about is that his skills are skills that I don't have. And so if you're thinking about whether or not you need a co-founder, I often say to people, that's a criteria that I think you should assess. Does this person have the skills that offset my skills to make a successful business? And then I say, the last thing you should think about is, will it hurt your chances of raising VC if that's the path that you want to take your company if you're a solo founder? And I mean, I would argue that it just, that's a typical lawyer, it depends statement, right? Have I seen or heard of VCs who don't want to invest in solo founders? Sure. Have I heard of VCs who only invest in solo founders? Sure. I've worked for a solo founder. It's not an impossible hurdle to overcome, and I'm not even sure it's a hurdle, right? It just means that you have to be a little bit more targeted in your outreach. What is a cap table? So I, as an attorney, I have been involved and worked on cap tables pretty extensively. And a lot of people seem to get confused about capitalization tables. At the end of the day, as a lawyer, one of the things I'd often say to the companies I represented is you just need to stay organized, right? You need to have a record and you need to keep track of that record. And that's what a cap table is. So I'm only going to touch on two things. One, authorized shares versus issued shares. Those are the two concepts you really need to be familiar with. Authorized shares is the number of shares that you authorized in your certificate of incorporation for the company to issue. A lot of people compare cap tables to pie charts or pies. That's fine if you want to think of it like a pie. But if you want to think about authorized and issues in terms of a pie, then your authorized is your crust and your issued is the inside filling. There's always going to be, not always, but most of the time, there will be more authorized than there are issued. Issued are the shares that the board says, we're granting 350,000 shares to founder one. And that is an issued number of shares out of the authorized number available. So I'm providing you with this example of a simple cap table Excel file. Obviously, it's fake data. But as you can see, the company granted shares over time. And that's because they had enough authorized in order to keep granting shares, to issue those shares. The other thing I want to talk about when it comes to cap tables is preferred versus common. Those are two different types of stock. Preferred, the reason that we often refer to it as preferred stock is because it comes with preferred rights. Typically, common stockholders do not have the same rights and preferences as the preferred stockholders. And so when you're selling stock of your company to a venture capitalist or to an angel investor or to whomever is taking equity in your company, they will typically want the preferred shares, and you will want them to take the preferred shares because they'll pay more for preferred than they will for common. Conversely, when you're issuing shares to your employees, they don't want to pay a high premium for the equity that they're getting, and you don't want them to have to pay a high premium. And so you grant them common stock. This can also be for your advisors, anyone else who is like a consultant to the company. Common stock is what you will typically be granting to them, issuing to those people. Next topic, advisors. I just mentioned them on the cap table. When you are starting out a company and you have an idea, a lot of people are going to be willing to help you along the way. And you will have in your head the question of, do I make this person an advisor? Do I give them some equity? I can't tell you the answer to that question. That's really up to you. But I will say, people often ask, other startup founders have asked me, how much equity do I give to an advisor? And here's the thing. We didn't really talk about options when I talked about the cap table. So let's talk a little bit about that. I'm going to backtrack for a second. An option is the right to buy stock. So in this context, it's the right to buy common stock, right? Because you're going to give it to an advisor. So you're saying to them, you will have the right to buy common stock in my company if you do this one thing or these 5 things. And usually the thing that you're tying the right to buy the stock to is time. So if you take on an advisor and they are supposed to provide you with advice, contacts, a network, how to execute better, product feedback, customers, whatever it is, you can tie their commitment to your company and the amount of stock that they get to that time. So I will grant you an option to buy stock in my company every month for a year. And that total amount of stock that you can buy will be worth 1% of my company. And I think that's worth it because, you advisor, you're going to introduce me to my first 5 customers. And that's so incredibly valuable to me that I'm willing to give up 1% of my company. Or, you're an advisor, you helped me do this one thing that was extremely useful. So I'm just going to go ahead and give you a grant that's 0.1% of my company for that one thing that you did. Thank you. So that's how you think about advisors. Incubators and accelerators. I guess I'm going to show a little bit of my my age on this one. When I first started representing companies, incubators and accelerators were not around. We know Y Combinator started, I think, in the late 2000s, like 2009, something around that time. And it was not something that I was very familiar with until I got into being a startup founder myself. When we started ClearOps, one of the first things that we started to do was to look at the different incubators and accelerators. Now, just a moment of my understanding of the difference between an incubator and an accelerator. An incubator is you have this idea and that's it. You need someone to help you start executing. And that's what an incubator does. An accelerator is I have an idea, I've started building, and now I need to accelerate. I need to push the gas pedal down. That's how I think of them in my head. I'm sure there are people who are going to say, well, it's not exactly quite right. I think there's also been a lot of blurring lines when it comes to those 2 different types of programs. But for purposes of this presentation, I wanted to focus on just a few points. The first one is know the math. What do I mean by knowing the math? If you are joining a program where they offer to provide you with $100,000 in exchange for 10% of your company's equity, you are getting $1 million valuation on your company. That is what that translates into. You need to be comfortable with that. If you are going to join a second program and they too are giving you $1 million and taking 10% of your company, you are now spending 20% of your company's equity on a couple of programs. And that's where I talk about due diligence. Do your due diligence. Make sure that the program you're joining not only is worth it to you, but that you get the benefit of it. In other words, if you join one of these programs and you take the money and you do not take advantage of the offers that they're giving to you, whether it's partnerships, introductions to customers, introductions to venture capitalists, it's the weekly training that they're doing, right? The introductions to law firms, the free law firm services that you're getting, or the accountants. There's a lot of things that these programs do for companies, and it's all in exchange for that equity that you're giving up. And so if you don't take advantage of the program, if you don't actually go through the program and take advantage of all the mentorship that they're offering, then you have to question whether or not that much equity of your company should have been granted to them. Now, of course, when you grant equity at the early stages of your company, it will eventually be diluted, right? I mean, because you will be offering more and more equity to others as your company grows. However, you're starting from having already diluted yourself quite a bit. So that's why I'm saying know the math. Some of these programs don't actually ask for equity. Some of them ask you to pay them. That's a personal preference. I really can't tell you one way or the other. I have, on behalf of ClearOps, we have joined programs. Currently, we're a member of the NYU Future Labs. I know other people who run different programs. Like I know there's, we talked about Y Combinator. I know there's ERA. I know there's Halo. There's a bunch of different programs that are available to you. And some of them are going to be asking for you to pay them, and some of them are going to take equity, and some of them are just going to be free. Just do what's right for your business. Creating your list of VC. Now, so far, this talk, we have really focused on going for venture capital. And I do that because that is really my background. As an attorney who worked with startups who were seeking venture capital, as a ClearOps founder, and we are seeking, we're going down that same path of seeking venture capital. This is where I am most familiar with. However, if you have absolutely no intention of seeking venture capital, then this part of the presentation is not for you. But I do want to talk about how you make sure you get to the point of fundraising, right? I mean, this whole presentation is about going from the idea to fundraising. And it's not a linear path. You have to start thinking about who you want to invest in your company the minute you have your idea. And you have to start building your list. I can tell you from personal experience, the most difficult and not often talked about problem with going out to the market to try to raise money is trying to get the email, trying to get in front of the VC, trying to get that personal introduction. We have all heard about the warm intro. We've all heard about these lists that exist throughout the internet. But actually getting in front of someone takes a lot of time. You might think to yourself, I'm going to run a process. It's going to take 3 months. On day one, you have your list of all the venture capitalists you want to reach out to, right? You have it in your Excel file, Google Sheet, Word document, whatever it is. You have this list. You have done your research. You know who they are. You know what you're going to say. And on day one, you sit there and you think to yourself, now what's the email address? Or what's the phone number? How do I get that? And then you finally get the email and you email the person, and then you realize, just like in sales, it takes 4, 5, 6 emails, which takes 2, 3, 4, 5 weeks. So the best thing that you can do, and the best advice I can give you, is just start building your list the minute you go from, I have an idea, to I'm going to execute on this idea. I'm actually going to take the leap of faith. So in this context, what I'm saying is, if you were introduced to a VC, whether you're on Twitter, however it is, you add them to a newsletter. You talk to them. Maybe you're too early. You're at the friends and family stage and the VC says to you, yeah, keep in touch. That's great. Actually keep in touch with them. How do you keep in touch with them? You start an investor newsletter. So you create this newsletter, and the best thing you can do is keep a cadence, monthly, quarterly. I am not good at this. I have full transparency. I have said to myself, I will send out the newsletter monthly, and definitely there are months that I end up skipping. For example, I missed January this year. That was not great. But you just got to keep pushing. You got to keep trying to get yourself into the cadence and do the best you can. Because the people that are following you on this investor newsletter, they're the ones that are going to be your first point of contact when you're ready to actually raise. So in this newsletter, I have learned a few things, and I thought I might share these tips with you. The first one is be short. I mean, I'm a lawyer. I'm wordy. I mean, there's just no question about it. I've built that way. I have been trained to talk a lot, as I feel like I'm talking right now. And I have gotten feedback again and again and again, which I love, that I need to keep it shorter. The next one is that they really do want to see metrics. They want to see you constantly keeping track of the numbers. Generally speaking, what that means is they want to see the number of customers, or the number of phone calls, or your pipe, or your users, or your beta testers, whatever it is. They want to see that this idea that you have, sure, they want to see that you're executing and building the product, but they really want to see, is this going to take off? If you're going after VC, That's what they want to see, as far as I know. And then finally, use your audience. Make an ask. It's not a bad thing to do every single time if you can. Sometimes, it might be a month where you just don't have an ask. But remember, this is a list of connected people. You should be asking them for help. So in anticipation of this presentation today, I reached out to my network on LinkedIn, which I'll provide my LinkedIn contact at the end of this. And I reached out to them and I said, what should I talk about? I already had an idea, of course, because otherwise I wouldn't have proposed this topic. But I said to LinkedIn, here's the list of things I'm thinking about talking about. What else should I talk about? And I got the talk about go-to-market. And then, coincidentally, I happened to attend a training on go-to-market. So I thought, I'll add it in, and I will bring in some of that training that I just personally received. But the reason it's so important is basically from what I was just saying about your investor newsletter. The fact that you have a market that is large and a huge potential that maybe no one has really understood or figured out before you, that's what your investors want to see. That's what they want to know. And the best thing you can do for yourself is to know it really, really well. So when you have an idea, right, you're at the very, very early. I said validate your idea. Go out to 100 people. Ask them, if I built this, do you think this is useful? That's going to give you the confidence to know there is a market. Maybe it's only 50 people. I don't really care what the number is, just as long as you know that there's a good sample of people who think that your idea has legs. Well, now we're in the building part, right? You've taken that leap. You're now building. And you have to think to yourself, who's my buyer? Who am I going to sell this to? And when? When do I start selling? Do you start selling before you have a product? After you have the initial product? How do you sell to someone a product that isn't finished? These are tough questions that I asked myself. In fact, when we launched our beta, I had 10 people who were ready to try it out for me. And they were kind enough to do it. And I got a great amount of feedback from that. The number one piece of feedback I got was, who are you selling this to? Which, when you're going out to 10 beta testers and they're wondering who you're selling it to, it means that none of them were sold, right? That was a hard moment. I spent a whole weekend just running it through my head over and over and over again. Who are we selling this to? And so then I thought to myself, well, I need to go get a customer, because I need to find someone who's actually going to pay me to do this, because that will give me focus. And that's what I did. I actually managed to find, I reached out to 4 different potential customers, and within about a month to 2 months, I closed 2 of them. Now at this point, I had that beta product, but I didn't really have a product I could serve to them. Because of the beta testing, we did a slight pivot. And so it was just me. It was, what did someone call it? They called it the Wizard of Oz, I think. It's the man behind the curtain, or the woman behind the curtain, or the person behind the curtain, right? It's someone who's doing everything, but making it look like there's something that is not all manual. That's what I had to do. So taking on 2 customers was actually taking on a ton of work. I felt like I was back in my days of being a lawyer again and doing a ton of client work. But it validated for me that I now had direction and focus and someone willing to pay for it. And so that's when we started building the product. But as you know, your MVP changes, or maybe you don't know, but it does. Your MVP will change along the way. You'll have your first stage of the MVP, what you think is the very, very minimum, right? And probably you price it. I mean, I'm sure I know I priced it too low, but it was a very basic product. Go out and try and sell that. And all the time you're still building. And then you get your next release, your next couple of features, and you're thinking, oh, well, this is a better product now, so I need to go sell that. And this is what happens is you keep building, you keep trying to sell, you keep trying to find, who is the target customer, where's the market. And sometimes, like in my case, COVID aside, which I can go into, but I won't, you may find that you can't actually convert the customer until you get to that one thing that everybody really just wants. And so when you finally hit that, then you have your go-to-market. And that is what I have discovered, is we hit that. We finally put in the one thing that everybody wanted, and then all of a sudden, we found our market. So how do you do your go-to-market? I'm not going to say that I'm an expert at this. I'm definitely not an expert at this. I'm just going to tell you what my experience was, and I'm just going to give you some tips and advice, and hopefully it's helpful. So the first thing I know about go-to-market is you have to come up with a strategy. The strategy is two things, really. It's who is your buyer? Who's your customer? Who are they? What do they look like? When I went out to the market, I thought my buyer was me. Caroline McCaffery. I thought I just need to go find the Caroline McCafferys of the world and we'll be set. Turns out I was wrong. It wasn't Caroline McCaffery. It was somebody else. So you have to be willing to try different things. If you haven't read the book Traction, I recommend it because it opens up your eyes to all the different ways that you can find who your buyer is. And the best part about that book is it says you may find one buyer that is really successful for you for 6 months, and then all of a sudden that starts to slow down, and you might think, oh, this isn't as big a market as I thought it was. No, don't think that. Definitely don't think that. You just need to switch your traction method to another one that opens up another large market to you. That was eye-opening to me. I love that. The second part of your strategy is, what's your message? And this kind of goes to my beta testers, right? That's what they were really asking me. They weren't asking me what to do with the product. They thought it was cool. They just didn't know what the message was. What's the purpose? What are you trying to tell me that this is going to help me do, right? When you're building a product, you're building it to help someone do something. And that's what they care about. It's that doing something that they care about. So focus your message. And then once you have that strategy, you go out and you execute on it. When I first started writing my pitch decks, I talked about our go-to-market as being direct sales. Finding the Caroline McCafferys of the world. Now I understand that there's indirect sales, direct sales, there's SEO, there's social, there's email, there's even sending people physical mail. There's partnerships, there's channels that you can open up through the partnerships. That's all execution. When you're talking about your go-to-market, what most people want to hear if they're looking to invest in you is your strategy. They already know you can execute. You have gone from an idea to now building a product. So clearly you can execute and you are someone who executes. But you need to make sure you take that time to build the strategy. Because if you can show the strategy that the machine is working, then that makes it all the much more powerful of a go-to-market. Okay, I think I slowed down a little bit, so I might have to speed up here. Next is the pitch deck. The reason I spent so much time on go-to-market, because it's so important, is because it's what they're going to ask for you in your pitch deck, right? I have done so many pitch decks. I've looked on the internet and there's a bunch of pitch decks, like the first pitch deck for a bunch of companies on the internet. And I think to myself, I will never, ever publicly display my first pitch deck because it was awful. I am a lawyer. I am not a designer. I am not good at designing pitch decks. And thank goodness there's products out there today that help you with designing pitch decks so that all you have to do is think of the content. Again, I'm a wordy person, so coming up with the words is not the hard part. It's just cutting them down. Frankly, that's the harder part. So what I've learned about pitch decks, and I just hopefully it's helpful for you as the listener and watching this, is the first thing you need to have is a short teaser deck. You don't have to send your teaser deck to every single VC that you're reaching out to. You don't have to include it in the email. Less is more in a lot of cases. But you want to have the short teaser deck, and you want to make sure that it gets across the things that they're looking for. My best tip on that is, if you think about it this way, let's say that you happen to have $10,000 that you were going to invest in one company. When you look at your pitch deck that you put together, would you invest in your own company? Did you convince you as the investor to invest in this company? Did you make it exciting? Did you make it interesting? Did you explain it well? I have asked a ton of people, what's the worst mistake that most founders make in their decks? And the answer that I've gotten more often than not is the problem statement, actually, which I find to be super interesting, because I think most founders, when you're at the idea stage, it's all about the problem. I think it's when you go to describe it, once you have the solution, really, it just changes for some reason. It's harder to describe. But the other thing I'll tell you I've learned about the teaser deck is the go-to-market. It's really what investors want to see. They want to know that there's a huge upside potential, but they also want to know that you've figured something out, that you have seen the market opportunity, and you need to figure out a way to convey that. If you've had 100 conversations with potential customers, and they all look at you and they say, oh my gosh, you have created something that is so needed, you need to make sure you convey that to the potential investor who's looking at your deck. After the short teaser deck, you need to have a very, very long appendix. I mean, I'm not saying, oh, you need to have 30 slides. I don't mean that long. I mean, you need to really put the time and the effort into it. You need to go through the exercise of working on financials and projections. It's really, really important. Even if you're completely wrong, which in my experience, having run the finance team at one of my startups, projections are incredibly challenging to do. But it's worth going through the exercise, because it does, actually, what it does the best is it sets goals for you. The other thing that you really want to spend time on in your appendix is the metrics you're tracking for your business, and telling the investors, this is the metrics. These are my key performance indicators. These are the things that they want to see, because they want to know that you're seeing in the data the potential. So I am the CEO and co-founder of a company called ClearUps, as I've mentioned a couple times. I could not possibly give this presentation without talking about privacy and security. Privacy is something that came into the spotlight with COVID more so than it had before. Part of that is the legislation that's happening. Right now, between many of the states that have adopted new regulation and the European law, privacy legislation affects every single startup company. Whether you're B2C or B2B or B2B2C or B2B2B, doesn't matter. You're probably processing some type of personal information, because you can't not. Actually, I mean, privacy laws, a lot of times we think about it as a user's privacy, but it's not just user privacy. It's also the privacy of your employees' information. You collect a lot of information about your employees, their salary, their social security numbers, all types of things in order just to pay them. Well, if that got out, that's a breach, and you have to do things. So it's really, really important to think about privacy and security from the very beginning. And the reason you have to think about them both is because you can't really execute on privacy without having security in place. So I list here a few of in this slide, I list a few of the things that a lot of startups are having to deal with these days. Cookies is coming under great scrutiny. If you have cookies that are dropped on people's browsers, from the browser onto their computer, there's things that you need to do. Sure, you've all seen the cookie banners. We all hate them. But it can't be a simple click consent. And it certainly can't be a drop a cookie and then see if they consent. Subject access rights, these are now the requests by users to your company saying, hey, I know you collect data on me. I want to see what it is. Same with the right to delete. Hey, you collect data on me. I want you to delete it. Do not sell. Hey, you collect data on me. You can't share it with anybody. Vendor management. This is really very, very popular right now because of the SolarWinds hack, and it should have been popular years ago. This is organization. You need to know the vendors that you're using for your business. And I'm not talking about the ones that you pay. I am talking about them, but I'm not just talking about them. Not just the ones that are on your payables. It's also the ones that collect data and then don't charge you. You need to manage those vendors. You need to know who they are. You need to have it in an organized list. And then, of course, you get to the things that ClearOps handles, which is the vendor management, risk assessments, privacy impact assessments. That's what we do. But the main point that I want to make is starting a company today, if you're at the idea stage or you're in the middle of the execution of your MVP, make choices that respect users' rights to privacy and security. Please. It's really important. So it looks like we have a little bit of extra time. I went through everything pretty quickly. If I have a bit of extra time, I might actually touch a little bit more on options and stock grants. But a friend of mine said, you know, Caroline, you should talk about imposter syndrome because it is something that comes up quite a bit, especially when you're in the early days of starting a company. And so I put this quote on here because it's a friend of mine who recently said this, and I love this. Building a company is hard. It may be the best thing you've ever done. It may be the most fun that you've ever had. It's also going to be the most misery that you've ever had if your experience is anything like mine. And you'll get a lot of feedback, a lot of advice. People love to give advice. And, you know, frankly, I'm the type of person who loves to not only give it as I am today, but also to receive it. And I truly believe in this quote. I love constructive feedback. It only could make me better. But I only love it when it's fair. And so when you're talking about imposter syndrome and the challenges that we go through in starting companies, you know, not every company is going to get funded by a venture capitalist. You may have to raise friends and family, and that's it. You may have to bootstrap. You may want to just bootstrap. But there's going to be moments of, I mean, in my case, I'll just talk about myself. There have been lots of moments of doubt, right? Can I do this? Is this going to happen? And they can be very challenging to overcome. When I'm just going to be, you know, completely honest with my experience of going out and trying to raise VC money. It tore down my confidence. It really did. I was having a rough time. Thank goodness for George, because as my co-founder, he was the rock that I could talk to after I would have one disappointing conversation after another. When you're going out to raise venture capital, they say you have to talk to hundreds to get to one yes. And if you're someone like me where hearing no over and over and over again starts to impact your confidence, then that's what happens. And it does make you have, you know, I don't really like the term imposter syndrome. I just like the term hurting your confidence, because that's what it did to me. It hurt my confidence. I had to get it back. And I knew I had to get it back. It's kind of silly in a lot of ways. Here I am. I had an idea. I built a product, right? Obviously not just me, it's with my team. But we built a product. We have people who literally their eyes, they're just like, they open really wide when they get the demo. This is awesome. And here I am feeling sorry for myself because a venture capitalist said, thanks, but you know, we need to see you get to 1 million ARR before we'll invest. So I had to go back to my core. Why did I do this? Why did I start a company? Why would I put myself through this? And the core told me, you did it because you wanted to help people. That's why. You didn't do it because you wanted to raise money. That was never the intention. And so I said, okay, yeah, that's right. That is why I do this. So let me go back and hopefully get my confidence back by helping people. By going out and talking to the customers, going out and talking to prospects, hearing what their problems are, and telling them that I have a solution. That is where I got my confidence back. And that is where I am today. And it feels good. And so I just want to pass along that little tidbit of advice, if I can, is never lose sight of why you got into this in the first place. There's going to be a lot of rejection, a lot of tough days. There's going to be days where you're about to give a demo and your whole system is broken. This stuff happens. But just remember, you did this for a reason, and you did it for a good reason. All right, so we finished the whole thing in an hour. I said I might circle back if I had a few extra minutes on the difference between an option and a stock grant. I'm just going to do that really quickly. Again, reminder, disclaimer, I am not giving any legal advice, but I think it's important for founders to know this. An option, you cannot grant an option unless you have gotten approval of your option program from the state. You have to make certain filings for securities purposes, but an option is the right to buy. A stock grant, which is what founders receive when they start a company, it's an outright stock grant. It is, you pay some small amount of money because you just started this company, it's not worth anything, and you own the stock. Now, vesting applies to both. In the case of options, the vesting is the condition for you to exercise the option. In a stock grant, they call it reverse vesting because it's the opposite. You own the stock and you get to keep it unless this condition is met. So you own the stock and you get to keep it unless you leave within a year. Then you have to give it all back. We buy it back from you at your cost. Something to keep in mind. Something to be aware of as you're starting a company. And the last thing I'll talk about just briefly is crowdfunding. A lot of companies these days use crowdfunding, and this crowdfunding is a way for you to fundraise usually through these platform. There's crowdfunding platforms, and they take care of the securities requirements in terms of selling your securities, because whenever you sell a security, you have to worry about the securities laws, whether there's an exemption for your sale or not. And if you're going to do crowdfunding, the reason I have to bring it up is because it is another option, right? You can go VC, you can go bootstrapping. Crowdfunding, I kind of put it in the same bucket as VC. I know it's not. It's usually angels or other types of individual investors rather than investors who put together a fund. But not always. You can also find funds on crowdfunding. The only thing I'll say about crowdfunding is you have to, and it's the same point I made before. If you're going to go for crowdfunding, make sure you keep a clean cap table. In other words, keep a track record of all those people who invested in you through the crowdfunding platform, whether they are rolled up into one entity on your cap table or they're all individuals that are on your cap table. Keep it clean, keep it organized. As with everything, when you're starting a company and you're starting with an idea and you're trying to go for fundraising, keeping yourself organized, making sure you have every document fully signed, locked away in some sort of file system, your cap table is completely clean. These are the things that surprisingly will not only help you when you are getting funded, they may also be part of the reason why you do get funded. So that's it for me today. Thank you so much for joining and listening to this session. I have put some places to reach me. Of course, again, I'm Caroline McCaffery. I'm the CEO and co-founder at ClearOps. So I've given my information at ClearOps. You can also find me on Twitter and LinkedIn. Those are the only two social media outlets that I actively participate in. Thanks, and have a wonderful day.